When a partner withdraws, retires, or dies, his interest may be purchased by one or all of the remaining partners, or settled by the partnership. The interest of withdrawing, retiring, or deceased partner is adjusted for the following. Number 1, his share of any profit or loss during the period up to the date of his withdrawal, retirement, or death, and his share of any revaluation gains or losses at the date of his withdrawal, retirement, or death, and lastly, his loans and advances, if any. One or all of the remaining partners may purchase the interest of the retiring partner. This is accounted for as a personal transaction, and thus, the consideration is not recorded in the partnership's books. The only entry to be made is a transfer within equity. Please take note, however, that the adjustments to his interest, share in profits or losses, and revaluation are recorded first before the settlement. The partnership may settle the interest of the retiring partner, and this is accounted for as a transaction between the retiring partner and the partnership. As such, the settlement amount is recorded in the partnership's books, alongside any other necessary adjustments. When the outgoing partner's interest is settled at an amount greater than or less than the value of his interest, the bonus method is used. So to illustrate partnership retirement, let's answer the following problem. Statement of financial position as of September 30, 20x1 for the partnership of Debbie, Ellie, and Feli shows the following information. It was agreed among the partners that Debbie retires from the partnership and the assets should be adjusted to their fair value of $120,000 as of September 30, 20x1. Net loss prior to retirement of Debbie amount to $24,000. Debbie, Ellie, and Feli share profit of 40%, 10%, and 50% respectively. Ellie purchased 25% of Debbie's interest for $10,000, while Feli purchased the remaining interest for $30,000. Question: after the retirement of Debbie, how much would be the capital balances of the remaining partners? So this problem is an example of sale of interest to the partners. This is accounted for as a personal transaction. So any difference between the purchase price and the adjusted capital of the retiring partner will be taken as personal gain or loss. So to start, let's determine first the capital balances prior to retirement. So Debbie, Ellie, and Feli, and then total. So for Debbie, we have 29,000. For Ellie, 27,000, and lastly for Feli, 63,000. Then we determine the total. So total would be 29 plus 27 plus 63. We have 119,000. So these capital balances are balances prior to retirement. So these are not yet adjusted with the effect of the revaluation. So let's incorporate this effect, revaluation, as well as the net loss. Okay. So revaluation is the difference between the book value of the assets and the fair value. So that is simply 126,000 less 120,000. So there is 6,000 downward revaluation. This downward revaluation will be distributed to the partners in the ratio of 4:10, 40:10, 50, their profit and loss ratio. Then, net loss will likewise be distributed to the partners. The net loss amounted to 24,000. Okay, so since both of these items will be distributed in the ratio of 40 to 10 is to 50, we can simply combine them to save us some time. 30,000 times 40%, that will give us 12,000. And then 30,000 times 10%, that is 3,000. And lastly, 30,000 times 50%, this is 15,000. Okay. So these two items are incorporated already in the capital balances. Let's compute for the adjusted capital balances. Okay, so we have 17,000 and then 24,000 and lastly 63 minus 15. Okay, 63 minus 15, that is 48,000. And of course, for the total, so that is 119 minus 30,000, that will give us 89,000. Then 25% of Debbie's interest will be purchased by Ellie. Okay, so 17,000 times 25%, that is 4,250. Okay, I'm sorry. So 4,250 for Ellie. And then the remaining 75%, which is equivalent to 12,750, will be purchased by Feli. Okay, of course, the total will be 17,000 and it will not affect the total partnership capital because it is simply a sale of interest to the partners and accounted for as personal transaction. So after the retirement, so capital balances after retirement would be as follows. So of course, for Debbie, it will become 0, and then for Ellie, this will be 28,250, and lastly, for Feli, this will be 60,750. When we combine these two, of course, 89,000 will be the sum. Okay. So this is how we compute for sale of interest to the partners. Now, let's proceed to another problem. And this problem is an example of a transaction between the retiring partner and the partnership itself. So the retirement will be settled by the partnership. Okay. So effectively, it is almost the same. Anyway, the statement of financial position as of September 30, 20x1 for the partnership of Debbie, Ellie, and Feli shows the following information. It was agreed among the partners that Debbie retires from the partnership and the assets should be adjusted to their fair value of 120,000 as of September 30, 20x1. Net loss prior to retirement of Debbie amount to 24,000. Debbie, Ellie, and Feli share profit of 40%, 10%, 50% respectively. The partnership paid Debbie 22,500 cash for her partnership. Okay, so this statement implies that this is settled by the partnership. So the transaction is between the retiring partner and the partnership. Okay, so the consideration or the settlement to be paid to Debbie will be recorded in the partnership's books, not only the transfer within equity. Okay, so the question again, after the retirement, how much would be the capital balances of the remaining partners? Okay. So let's again compute for the capital balances prior to retirement. Okay, so Debbie, Ellie, Feli, and then total. So 29,000, 27, and then 63. So we have computed this a while ago, and the total is 119,000. Now, so let's adjust these capital balances. So we have, of course, the revaluation, the share in net loss, and lastly, okay, so the last item, which was not present in the previous problem, is the loans and advances of the retiring partner only. Okay, so loans and advances. Okay, so for revaluation, we have computed this also. Anyway, so that is simply 126,000 less 120,000. So the fair value is less than, and that's why it's a downward revaluation. And the net loss is 24,000. Okay, again, both of these items will be distributed in the ratio of 40:10:50 respectively, and then we can combine them. So 30,000. Okay, so that is simply 30 times 40%. This is 12. And then 3,000. 30 times 50%. This is 15,000. So we have 15,000. Now, for the loans and advances of the retiring partner, we have 7,000. So loan from Debbie. Okay, so this is a liability of the partnership to Debbie. So it's payable to Debbie. That's why it will increase her capital interest. Okay, so these are the adjusted capital balances or capital interest. Okay, so we have 29 minus 12 plus 7. This is 24,000. And then another 24. And lastly, 63 minus 15. $63 minus 15. So that will give us 48,000. Okay, so 119 minus 30 plus 7. So that is 96,000. Okay. So now the partnership settles or paid Debbie 22,500 for her total interest. So as you can see, the amount settled is less than the total interest of the retiring partner. So the difference is 1,500. How do we deal with this difference? Okay, this difference will be distributed to the remaining partners as bonus. So again, bonus method will be used. So this 1,500 will be distributed in the ratio of 10:50. Okay, so 1,500 times 10 over 60. Okay, so that will give us 250. Okay, and then the remainder would be 1,250. Okay, so it will not affect, of course, initially the total partnership capital. So this will still be 96,000. Okay, so this is 24,250, and then this is 49,250. Okay, so now Debbie retires. So settlement to Debbie. So 22,500. And then 22,500. Of course, just have to bring this down. So 0, this is 24,250, and then 49,250. Okay, so this one 96,000 less 22,500, 73,500. So this is the total partnership capital after the retirement of Debbie. So balances after retirement of Debbie. Okay. So these are your final answers. So that's it for partnership retirement.